What's up, everyone? Welcome back to the channel. In today's video, we're going to explain the difference between stocks and bonds. What are the key takeaways you need to know as an investor? Now, if you've ever looked at the stock market or even just kind of followed along with what's going on in the news, you may have heard the term stocks and bonds thrown around quite frequently. And if you're new to investing, or even if you've been investing for some time now, you may not be exactly sure what the difference is, and more importantly, what should your portfolio look like and what should you be investing in to start? Let's first talk about what a stock is. A stock represents fractional ownership in a company. When you buy a stock, you're essentially buying a small piece of that business. For example, let's say I own 100% of Alex's lemonade stand. If I were to sell 20% of my ownership in the lemonade stand to another investor, I would give that person 20% ownership in the company, but I would still own 80%. The same thing happens when publicly traded companies issue stock. They sell off portions of their ownership in order to raise capital so they can grow their business. And when you buy that stock, you become a shareholder of the business and you own a small piece of that company. Next, let's talk about what a bond is. Bonds are very different than stocks. When you buy a bond, you're essentially lending money to an entity, which could be a corporation or even the government. For example, let's say you lend $1,000 to a friend who borrows the money and agrees to pay you back 5% every year for 5 years. In this example, you would receive $1,000 back after the 5-year period plus an additional $50 for each year as interest. The same thing happens when you buy a bond. You're essentially giving a loan to a company or the government, and in exchange, they're going to pay you back with interest. Now, there are many benefits to buying bonds. One of the main benefits is that bonds typically offer a fixed stream of income. So, if you're looking for a more stable investment that can provide you with regular income, then bonds may be a good option for you. Additionally, bonds are generally less volatile than stocks, which means that they tend to experience smaller price fluctuations. So, if you're looking for a more conservative investment that can help you to mitigate risk within your portfolio, then bonds may be a good option for you. However, there are also some drawbacks to consider when it comes to bonds. One of the main drawbacks is that the returns on bonds are typically lower compared to stocks. So, if you're looking for a higher potential return on your investment, then stocks may be a better option for you. Additionally, bonds can be subject to interest rate risk, which means that if interest rates rise, the value of your bonds may fall. So, what should your portfolio look like? The truth is that there's no one-size-fits-all answer. It really depends on a number of factors such as your age, your financial situation, and your investment goals. However, as a general rule of thumb, many experts recommend that investors allocate a portion of their portfolio to bonds, especially as they approach retirement. This is because bonds can help to provide stability to your portfolio and can help you to reduce risk. That being said, it's important to remember that all investments carry some level of risk, and there is no such thing as a completely risk-free investment. Please make sure to like and subscribe if you haven't done so already. Thank you guys so much for watching, and we'll see you in the next video.